Hello everybody, my name is Michael Quinn. I'm one of the directors of the Quinn Group. This month on Quintessential TV, we'll be discussing transfer pricing considerations. Any Australian business looking to expand overseas needs to consider the application of Australia's transfer pricing rules, as well as the respective jurisdiction transfer pricing rules. Where a company engaging in cross-border dealings with its foreign subsidiary obtains a transfer pricing benefit, the transfer pricing rules apply automatically to substitute the arm's length conditions for the actual conditions that produce the benefit. From the outset, the Australian Taxation Office, the ATO, expects that governance procedures are put in place to ensure that international related party transactions are priced based on arm's length conditions. The purpose of the relevant subdivision in the Tax Act is to ensure that the Australian tax paid on cross-border transactions is not less than the amount that would be payable if the parties were dealing at arm's length. In an outbound investment scenario, the Australian company is required to test whether a transfer pricing benefit has resulted from conditions that operated between itself and its foreign subsidiaries or other related parties in connection with their commercial and financial relations. Thus, under the transfer pricing provisions, the Australian company is required to compare the actual conditions with the hypothetical conditions that might be expected to operate between an independent parties dealing wholly independently with one another in comparable circumstances. The transfer pricing rules in the foreign jurisdiction will also need to be considered. The transfer pricing rules in most jurisdictions are based upon the arm's length principle, which means in most cases they are generally aligned with the principles in the Australian transfer pricing rules. However, there can be local nuances in the transfer pricing requirements in some locations, and some countries, notably Brazil, adopt rules which are not based upon the arm's length principle at all. An Australian company with subsidiaries and/or branches offshore will need to ensure they have developed and implemented appropriate transfer pricing policies for their intra-group transactions, as well as complying with any relevant documentation and disclosure requirements. Some jurisdictions have mandatory transfer pricing documentation requirements, while in Australia, transfer pricing documentation is not mandatory, but is required to establish a reasonably arguable position in the event of a dispute with the ATO. And disclosures are required in the International Dealings Schedule if the value of international related party dealings exceeds $2 million Australian. If you'd like to know more about transfer pricing considerations or you need advice in this area, please contact us. You're welcome to email us at info@quinns.com.au. We'd love to get your feedback with relation to Quintessential TV, so please like, comment and subscribe. We look forward to seeing you again next month. I'm Michael Quinn. Bye for now.